Almost everywhere in finance, the answer is the same. Nobody knows what your money will actually do, nobody knows what the price will be, and nobody can reliably pick winners. Today, the exception. There is one corner in finance when you can know what you will get back and exactly when. It's the most boring instrument in finance, and almost everybody misunderstands it. Hi, I'm Marco, and welcome to Rich in 10. On this channel, we'll talk about early retirement in Europe without hype, focusing on what actually works. In this investing series, we are covering productive assets, so stocks, bonds, and real estate. We have covered stocks, link in the description below, and we will go now to the next one. When you have stocks, you own something. When you own a bond, you lend money to somebody else. Now, let's try to understand this with an example. Imagine the orange juice company that wants to grow faster. Then they want to buy a bigger machine. The only problem is that they do not have the money. So how to raise capital? They could sell more shares, or they could borrow the money. They can find some lender that will borrow them the money, and they can agree on two things. The first one is the interest rate they will repay this person for the loan, and the second thing is they can agree on the end date of the loan. When they reach the end date, they need to give back the money to the lender. That's a bond, a loan with a schedule written on it. You are not an owner sharing the upside, you are the lender. And this is why, except one case, you know in advance the outcome. So if a bond is that simple and this predictable, how come people still lose money on them? Well, there are two reasons. The first one is obvious, and the second one is a trap almost everybody falls for. So in bonds, everything is based on one assumption, that the borrower will not go bankrupt. But if this happens, if the borrower goes bankrupt, well, you have a big problem because it's not assured that they can repay you. That is the real risk with bond, not that the price could fluctuate. So the most important question before you lend isn't how much interest, is who am I lending to and will they be able to repay me at the end? Now, there could be two kinds of borrowers. There could be corporate bonds where there is a corporate issuing a bond, so they want to borrow money from you, or there could be countries or other entities that do offer the same. So they want to borrow money from you and they will pay you an interest. Now, you cannot analyze all the financials of every company or every state. This is why there are rating agencies that do give scores to different bonds. It's almost a law in finance that riskier will give you higher return and less risky will give you more stable returns. So when you see a bond giving you a suspiciously generous return, this is a gift. This is the market telling you how nervous it is about it. The second reason why people lose money on bonds, the trap. It goes for all investments. Do not confuse the price of a thing with the underlying thing. Now, if you hold a bond to maturity, it will behave exactly how I explained. You agree on an interest rate, let's say 3%, then you will get paid via coupons before it expires or at expiration date, and then you get back your capital. There is a caveat to it. While you own the bond, you can sell to somebody else. And while you own a bond, the price does fluctuate. And why is that? Well, it's simple. Imagine that a company issue a bond that expires in 1 year at 3%. After 3 months, the same company issues a bond with same condition, except that now they pay 4%. If somebody needs to buy the original bond at 3% from you, will pay less than the original price. On the other side, if this goes in the opposite direction, the company issues a bond at 2% for 1 year well, your bond will be worth more at that time. So if you hold a bond to maturity, you will see interest plus the capital given back to you. But if you sell before the maturity date, basically when the bond will expire, well, the price can fluctuate. So you need to be careful about how the price fluctuates if you want to sell before maturity. So the price changing on a screen is pretty different from owning a contract. And people who panic at the price forget that they were holding a contract, not a ticker. If this is the kind of clarity you have been missing, please subscribe. It really helps the channel. This was the bond mechanism when you have one issuer. But this is also fragile because if that issuer goes bankrupt, then you could lose your money. So the question for you is, how can you become anti-fragile and own hundreds of bonds at the same time? Well, this is the subject of our next video. Hi, I'm Marco. Let's engineer your freedom. See you in the next video.